Federal tax credits are valuable tools. They incentivize activities like renewable energy and affordable housing. However, tax credits have limitations. Companies may lack the tax liability to fully utilize them, which reduces their impact. Traditional tax credits can be illiquid, making them less attractive to investors. Smaller companies especially struggle to use them effectively. The result is unrealized potential for economic growth. These limitations call for innovation. We need to make tax credits more flexible and more accessible. Converting tax credits into bonds can achieve this. Imagine this: federal tax credits reborn as bonds. This unlocks their value and allows a wider range of investors to participate. The concept is simple yet powerful. Companies with tax credits sell them, and investors buy them in the form of bonds. These bonds pay interest, which comes from the future tax savings. This process is a win-win, benefiting both the companies and the investors. Converting a tax credit into a bond involves several steps. First, a government agency or designated entity is needed to manage the process. This entity would ensure transparency and standardization. The issuing entity would purchase tax credits from companies. These credits would be pooled together and then used as collateral to issue bonds. The bonds would have varying maturities and interest rates depending on the risk profile of the underlying tax credits. Assigning a fair market value to tax credits is crucial. This ensures transparency and the integrity of the bond market. A robust valuation process is necessary. Factors to consider include the expected future tax liability of the company, the discount rate reflecting the time value of money, and the risk associated with the underlying tax credit. Independent valuation firms can provide expertise. Section 5. Structuring for success: the anatomy of a tax credit bond. The structure of the bonds is critical. It needs to be attractive to investors. The bonds would have specific features. For example, they could have a fixed or floating interest rate. They could also have different maturities. Credit enhancements such as guarantees could be incorporated. This would mitigate risk and attract a wider pool of investors. Section 6. A marketplace for growth facilitating bond trading. A liquid secondary market is essential. This allows investors to buy and sell bonds easily. This liquidity enhances the attractiveness of the bonds. Creating a secondary market requires a platform for trading. This could be an exchange or an electronic trading system. Clear regulations and standardized bond contracts are also necessary. This ensures transparency and investor confidence. Section 7. Navigating risk safeguards for a robust system. Risk management is paramount. This ensures the long-term viability of the system. Credit risk is a primary concern. This is the risk that the company issuing the tax credit defaults. Interest rate risk must also be managed. This is the risk that interest rates rise, reducing the value of the bonds. Diversification of tax credits and robust credit analysis can mitigate these risks. Section 8. The Low-Income Housing Tax Credit, a proven model. The Low-Income Housing Tax Credit, or LIHTC, is a successful model. It demonstrates the effectiveness of tax credit bonds. The LIHTC has been instrumental in financing affordable housing. It has attracted billions of dollars in private investment. This has resulted in the construction of millions of affordable housing units. The LIHTC's success offers valuable lessons for replicating this model. Section 9. Unleashing economic potential: growth through innovation. Converting federal tax credits into bonds is innovative. It is a potential game changer for economic growth. This approach unlocks the full potential of tax credits. It attracts a broader range of investors. This directs capital to crucial sectors. These sectors include renewable energy, infrastructure, and small business development. By embracing this innovative approach, we can unlock substantial economic potential. We can create a more robust and dynamic economy.